Hey everyone, and welcome back for another deep dive. Today we are talking about annuities.
Annuities and taxes, to be exact.
Right, annuities and
It's
taxes.
gonna be fun.
We're going to be using some insights from donpbaker Financial Group. Um, and yeah, we're going to be taking a deep dive into how annuities are taxed
Yeah,
so that you can make informed decisions
exactly. It's important.
with your financial planning. So let's just start right away with like the basics here.
Okay,
You have this annuity, it's hopefully growing nicely, and then you start taking money out.
right.
What happens?
Tax time, baby. No, I'm just kidding. Well, I'm not really. You have to pay taxes on it.
Okay.
So generally speaking, when you take money out of an annuity, those withdrawals are treated as ordinary income. But here's where it gets a little more complicated. The specifics really depend on whether you're dealing with a qualified or a non-qualified annuity.
Okay, so can you remind me what the difference is between those two? It has to do with where the money came from originally, right?
Absolutely. Yeah. So a qualified annuity is something that you'd find in a retirement account, like a 401k or an IRA. So you fund it with pre-tax dollars, meaning you haven't paid taxes on that money yet. So when you take withdrawals during retirement, the entire amount gets taxed.
Okay.
That Uncle Sam's finally getting his cut.
It's like delaying the tax hit, but then it eventually catches up with you.
Right.
Okay, that makes sense. And so what about non-qualified annuities?
So with a non-qualified annuity, you're funding it with money you've already paid taxes on.
Right.
So this means that when you take withdrawals, only the earnings portion is taxed because you've already paid taxes on the contributions.
Oh, okay.
You don't want to get double taxed.
So that's where the potential tax advantages come in
Yeah.
with non-qualified annuities.
Yeah, that and also you're getting a tax break on how much your investment grows, which could really add up over time.
Yeah, absolutely. So there is a benefit there. One other question about just like withdrawals in general. So I know this is a common misconception, but people think that if they start taking withdrawals, whether it's from a qualified or non-qualified annuity, that it's going to affect their Social Security benefits.
Yeah, no, that's not true. You're right, that is a misconception.
Uh,
A lot of people think that, but the Social Security Administration sees it a little bit differently.
okay, well, that's good to know.
Yeah.
Um, okay, so we've covered how the withdrawals are taxed, but what happens if you need to take the money out early,
Yeah.
before you hit retirement age? Are there any penalties?
Absolutely. You're going to get hit with a penalty. We're talking about a 10% penalty on anything you withdraw before age 59 and a half. And this applies to both qualified and non-qualified annuities.
Okay,
So you really want to consider that long-term perspective and the potential downsides of needing that money too early.
it's a big hit.
Yeah, it is a big hit. There are some exceptions to that penalty, but it's always best to talk to a financial professional just to make sure that you understand all the rules and that you avoid any unpleasant surprises.
Yeah, good advice, good advice. Okay, so let's dig a little deeper into non-qualified annuities. I feel like things get a little more complex there, right?
They do, and this is where understanding a couple of key concepts can really help you out.
Okay.
We're talking about the exclusion ratio and the LIFO rule. These are going to play a big role in how much you end up paying in taxes.
Okay, the exclusion ratio sounds a little intimidating. Can you break that down for me and the listener?
Yeah, so think of it this way. When you buy a non-qualified annuity, you're typically paying a lump sum up front, right? And then you start getting regular payments, maybe monthly, over a certain period. The exclusion ratio helps determine what portion of each payment is considered a return of your initial investment and therefore tax-free.
So it's like you're slowly getting your original investment back over time, and only the part that represents growth gets taxed.
Exactly, exactly. So for example, let's say you purchase an annuity for $100,000 and you're receiving monthly payments for 20 years. The IRS basically sees that as you slowly getting that $100,000 back over those 20 years. So a portion of each payment is a return of your principal, which you already paid taxes on, and the rest is earnings, which are taxable.
Gotcha.
Yeah.
So the exclusion ratio is basically a formula that figures out that breakdown.
It is, and it's unique to each annuity contract because it takes into account things like your age, how long the payment period is, and the expected rate of return.
Makes sense. Okay, and then what about this LIFO rule?
Yeah, life it sounds like accounting, right?
Yeah.
But it's a very important concept to understand because it affects how non-qualified annuity withdrawals are taxed.
Okay.
LIFO stands for last in, first out. Essentially, it means that when you start taking withdrawals, the earnings portion of your annuity is taxed before you dip into any of your original principal.
So help me visualize this.
Okay, picture this, right? You've got a delicious layered cake. And to get to the actual cake, you got to eat through that frosting on top, right? Well, in a non-qualified annuity, the earnings are like the frosting and the principal is the cake.
Okay,
The LIFO rule means you're essentially eating the earnings first, which are taxable, before you get to that tax-free principal, the cake.
I like that. That's a good analogy. Okay, so am I understanding this correctly? Early withdrawals from a non-qualified annuity, you might end up with a bigger tax bill
Yeah, that's right, you could.
because you're mostly withdrawing those taxable earnings.
Exactly. The timing of withdrawals, especially with non-qualified annuities, can have a significant impact on your overall tax liability. That's why it's so important to understand both the exclusion ratio and this LIFO rule to really minimize how much you're paying in taxes and make the most of your annuity.
Okay. Wow, this is a lot to think about. So before we wrap up, I want to talk about one other thing.
Sure.
Premium taxes. I'm curious about this one because it's not about federal taxes. This is like we're talking about state taxes on annuities.
You got it. Some states impose what's called a premium tax, which is essentially a sales tax applied to the amount you pay for the annuity.
Interesting. So is this something that everyone needs to worry about, or does it depend on where they live?
It definitely depends on where you live. It can vary from state to state, and even the timing of when you pay the tax can differ.
Oh,
Some states require you to pay it upfront when you purchase the annuity. Other states will add it to your premium payments over time.
gotcha. So just another thing to think about.
It is.
Okay, this has been a super helpful breakdown of how annuities are taxed. Clearly a lot to consider, but before we wrap up this part of our deep dive,
It's really important to emphasize that working with a qualified financial professional can be incredibly valuable when you're trying to figure out annuities.
yeah, I could imagine, I mean, as we've been talking about, there are so many moving parts to consider, especially when it comes to taxes.
Exactly. And a financial professional can really help you sort through all that, help you choose the right type of annuity for you and make sure that you're not paying more in taxes than you need to.
Yeah, so it's not really a do-it-yourself kind of thing.
Well, it's fantastic that you're taking the time to learn about annuities and everything, but when it comes to making decisions that could impact your future, having an expert there to guide you can be really helpful.
I agree. Okay, let's do a quick recap. We've covered a lot of ground here.
Yeah.
So first we talked about how annuity withdrawals are taxed. And the big thing there is the difference between qualified and non-qualified.
Right. With qualified annuities, the kind you usually find in those retirement accounts, you're going to get taxed on the whole amount when you withdraw money.
Right,
But with non-qualified annuities, you only pay taxes on the earnings.
right. And then we talked about those two key concepts for non-qualified annuities, the exclusion ratio and the LIFO rule.
It can be a lot to remember, but they're both super important because they really affect how much I'll end up owing in taxes. The exclusion ratio helps you figure out how much of each payment is tax-free. And then that LIFO rule, well, that means you're tapping into those taxable earnings first before you get to the tax-free principal.
Yeah, and don't forget those premium taxes.
Oh, yeah.
Those are the ones at the state level.
Right. And the rules for those vary from state to state. So definitely something to look into and think about.
Yeah, for sure. So with all this information we've talked about, what does it all mean for someone trying to decide if an annuity is right for their retirement plan? What's the big takeaway they should remember?
If we think about the big picture, the main thing to remember is that annuities can be a fantastic tool for generating income during retirement, but it's absolutely critical to understand how they're taxed.
Yeah, it's not just about having that income. It's about maximizing what you keep after taxes.
Right. Exactly. That's where working with a financial professional can be so helpful because they can help you weigh the pros and cons of different types of annuities based on your tax situation and make sure you're on track to reach your retirement goals.
All right, so as we wrap up this part of our deep dive, any last questions to leave our listeners with? Some food for thought as they consider annuities.
Definitely. Considering everything you've learned today, how could an annuity with all its tax implications fit into your retirement plan?
That's a great question. Really something to think about, maybe even talk to a financial advisor about.
Exactly. It's all about making smart choices that help you have a comfortable and financially secure retirement.
Okay, and that's a wrap for this section of our deep dive into annuities and taxes. It's funny because when you think about annuities, it just seems so simple.
Yeah.
Regular payments, right? But then when you start getting into all these tax implications and everything,
Uh-huh.
it's clear there's a lot more to consider.
Absolutely. And it's so important to understand what you're getting yourself into.
Yeah,
Especially when it comes to something as important as retirement.
for sure.
Annuities are great, but it's not a one-size-fits-all kind of thing.
Exactly. And that's why I think, as you've been saying, you really need to have a financial advisor in your corner to help you sort through all these nuances,
Yes, 100%.
like qualified versus non-qualified and those exclusion ratios and
All that stuff.
all that stuff,
Yeah.
state taxes, all of it.
Yep. And a good financial advisor is going to take into account, your risk tolerance and how long you have until retirement and your tax bracket and all that good stuff.
Right.
So that they can really put together a plan that works for you.
So for our listener who's maybe feeling a little overwhelmed by all of this,
Right.
what's the one piece of advice you would give them?
Don't be scared.
Yeah.
Don't let all this complexity prevent you from considering annuities because they can be a really great option.
Okay.
Knowledge is power, arm yourself with information, and most importantly, talk to a financial advisor.
Yeah.
Someone who can guide you through this process and help you make sense of everything.
That's great advice.
It is.
A well-informed investor is a more confident investor, right?
Absolutely.
All right. Well, thank you so much for joining us for this deep dive into the world of annuities and taxes.
Of course. Happy to be here.
And to our listener, until next time, keep exploring, keep learning, and keep diving deep.
See you next time.